I'm Craig Popp with Accrue Wealth, and this is Charts That Matter. As the S&P 500 continues to march upward, the path of least resistance appears to be higher. Through October 31st, the S&P 500 has registered 47 new all-time highs. The index is now sitting about 60% above its October 2022 low. In February of 2024, Episode 4 of Charts That Matter addressed the all-time highs associated with a bull market. The S&P had just reached a new peak, leaving investors concerned that the markets had run up too far too fast. My insights then? Extended periods of all-time highs are not to be feared and are not an indication of an impending reversal in the market. The business cycle and underlying trends are what really matter, and attempting to time the market perfectly doesn't beat sticking to an investment plan and a well-balanced portfolio. It's 8 months later, and that message is more relevant than ever. Let's look at a few charts that support my positive bias. First is earnings season. In sum, the third quarter earnings season has been healthy. Over 76% of S&P 500 companies have reported thus far. The third quarter year-over-year earnings growth has been revised higher to 6%, following strong results from mega-cap tech. Price reactions have been mixed thus far, with financials a standout, while industrials and consumer discretionary have lagged a bit. The overall message is consistent with an economy that continues to hold up well, but contains some pockets of weakness and questions regarding growth trends ahead. Next is seasonality. As October comes to an end, seasonality becomes more favorable. For example, November and December have been two of the best performing months of the year historically, averaging 2.5% and 1% respectively over the last 30 years. Additionally, the November to April timeframe is typically the best period of the year for market returns. I stress some caution about seasonality. As I mentioned in our third quarter commentary, the September-October period is typically one of the weakest in market history. This year, the markets have defied that seasonality and delivered strong returns during the period, even though we're in an election year. Next, I want to highlight credit spreads. In bond trading, a credit spread is the difference between the two yields of two bonds with the same maturity but different credit quality. Savvy investors recognize that credit spreads are among the best indicators of the broader economy's health, not just the credit worthiness of individual companies. A narrow yield spread suggests that investors are confident in the economic outlook and believe that the risk of corporate defaults is low. Meanwhile, a widening yield spread indicates increased concern about the economy. As investors become more risk adverse, they demand higher yields on corporate bonds to compensate for the perceived higher default risk, because the weaker the broader economy is, the more companies are likely to struggle with meeting their obligations. Corporate credit spreads remain very narrow and near lows. This indicates a lack of credit concerns within the bond market and is supportive of the uptrend in equities. There are plenty of things that can affect volatility or the pace of market trends, such as uncertainty regarding the election, geopolitics, inflation, economic health, sentiment, and positioning. However, I believe the positives outweigh the negatives and view the market with a positive lens. These positives include economic resilience, earnings health, easier Fed policy, price momentum, seasonality, and credit. And so I'll end with the same message I did before. Always be prepared for market swings and unexpected events. Avoid making rash decisions based on news headlines and focus on sticking to a well-diversified portfolio. Remember, With investing, the rear view mirror is always clearer than the windshield, but let's keep driving. The scenery has been pretty nice.